Thank you very much. Appreciate everyone coming to the panel. We're excited to discuss fixed income ETFs. So I don't think I've been behind one of these podiums. I feel like announcing a Senate run or something, but we'll jump right into it. So I'm going to have each of our esteemed panel members introduce themselves for a minute or so, and then we'll jump right into the material. Kevin?
Sure. I'm Kevin Mon. I'm the President and Chief Investment Officer at Henyon & Walsh Asset Management. We have about $6 billion in total client assets. We run 18 different ETF-based model portfolios, 14 of which are target risk, the other 4 are thematic. I also happen to be the Chief Investment Officer of Smart Trust Unit Investment Trust, which use ETFs in some of their underlying portfolios. I write the quarterly newsletter, ETF Insights. If you've ever heard of it, we've expanded the coverage to include closed-end funds. I write for Forbes, and if you recognize my face or my voice, I've been told I sound like Ray Romano, but I'm in the media a lot. I was on Fox Business News yesterday morning with Maria Bartiromo, Yahoo Finance yesterday afternoon, and I'll be back on Squawk Box on CNBC next Tuesday. So that's me.
All right, well, Brett, that's tough to follow.
Yeah, I was going to say, that's easy. I've done none of those things. Brett Shealy here. So I lead the team of ETF specialists at AllianceBernstein. For those who don't know, AB just launched its first 2 ETFs 2 months ago. And before that, I was at iShares, the BlackRock iShares program, for about 10 years and did a bunch of other things before that. But pleasure to be here. Nice to meet you all.
How you doing, everybody? My name is David Sharp. I'm a senior ETF capital market specialist at Vanguard. Really, the focus of our team is to try to create the best experience for our clients that are buying and selling our products. So working really closely with the liquidity providers, the market makers, APs, listing exchanges, facilitating all the creation redemption activity, coming through our desk, which has certainly been busy the last few years. And then we take that knowledge and we work internally to make our products better from a liquidity standpoint, and then take that externally for different client services, thought leadership work, to really try to spread the message on best practices and how to bring your orders to the market to get the best execution possible.
Hi, my name is Scott Peng. I'm the Chief Investment Officer of Advocate Capital Management. We provide asset and risk management services to clients via ETFs and separately managed accounts. We launched our rising rate hedge ETF on the New York Stock Exchange last year. Ticker is RRH. I'm happy to report that our one-year performance puts it in the top 5 out of 1,000 actively managed U.S. ETFs this past year. Personally, I've been in the industry for over 30 years, both on the buy side and sell side. Some of my prior roles has been as hedge fund and mutual fund managers at firms such as BlackRock and Oak Hill, and also head of U.S. rate strategy at Citigroup, where during the global financial crisis, I published an article called "Is LIBOR Broken?" that resulted ultimately in the replacement of LIBOR as a global floating rate benchmark.
Great. All right, thank you guys for that. So when we got together to discuss the panel, we thought it would make sense, at least for a couple of minutes, to just kind of set the table on where we are in fixed income markets, what you guys think the Fed's going to do, where the real risks lie, kind of what the new year is looking like, that kind of thing. So maybe Kevin and or Scott, a minute or two on that.
Sure. I'll start. It's not so long ago, if you remember, at the end of 2021, when the Fed published their dot plot chart at that time. If you know the dot plot chart, that's where all 17 voting FOMC members project where they believe the Fed funds target rate's going to go. But their projections coming into this year were for maybe 50 to 75 basis points in total of interest rate hikes. Boy, have we come a long way from that, huh? We remember in May when Chair Powell actually indicated that any rate hikes above 50 basis points weren't even under consideration. We've now had 4 consecutive rate hikes of 75 basis points, and I believe they'll scale back to 50 basis points after their December meeting. So it's been quite a dramatic run-up in rates to help combat these record-setting levels of inflation. That's created a lot of stress across capital markets, both equity markets and fixed income markets. In fact, the first quarter was the worst quarter for municipal bonds, investment-grade municipal bonds, in over 40 years. We also know that the first half of 2022 was the worst half for the stock market since 1970. But I do believe there are better days ahead. That's the somber introduction to actually bring everybody down and then lift you up from there. I do believe better days are ahead, right? I believe in December we will find out that, in fact, we've hit peak hawkishness as the Fed will now start to scale back the increments of their interest rate hikes, although they're not going to stop, I believe, until the end of the second quarter of next year. If they do start to scale back, that does indicate that, by extension, we've reached peak inflation. And history shows us, going back to 1927, that markets rally on average 11.5% in the year following peak inflation. So perhaps there are better days ahead.
Great.
Well, as a bond guy, I have to introduce some pessimism into into my outlook. I think, to understand where we are and where we might be going, it pays to think of the pandemic as a play in two acts. Act one is where goods inflation takes center stage. We had the pandemic hit, we had global central banks injecting massive amounts of liquidity, and as the economies start to reopen, we had obviously huge pent-up consumption on the part of consumers, and also supply chain snafus all over the place, right? You see pictures of trucks lining up, of ships kind of, lined up around the harbor. And that's really caused core goods to take center stage. So for the first part of this inflation bout, we saw core goods inflation lead core inflation. And that is actually a very unusual situation. If you go back to 1960, it's actually been core service leading core inflation 93% of the time. Now, that first act is coming to an end. Everyone's talking about supply chain snafus coming to an end. Is that the whole story? No, because Act 2 is about to start. And Act 2 is where core service starts to take center stage. And this is, again, core service usually does take center stage, usually does take a leadership role in terms of inflation. And core service is going to be a lot harder for the Fed to address. Why is this a pandemic's fault? Well, if you look at labor force participation rate, and this is something you hear almost every time the Fed has a meeting, it was 63.4 pre-pandemic. It fell massively as the pandemic hit, and it's been struggling to come back, and now it's about 62.2. And we've been in that area for most of this year. Now, you think 1-ish% doesn't matter that much. But if you could wave a magic wand and we bring labor force participation back to pre-pandemic levels, there would be 3 million more workers in the labor force. Incidentally, that's how much the JOLTS jobs wanted index is higher than the pre-pandemic level. 10 million today versus 7 million pre-pandemic. So this really highlights how hard a job it is for the Fed to really bring inflation down, because core service, as we know, is driven by wage pressure, and it's going to be pretty darn hard for the Fed to really bring this bout down. In our view, the Fed probably has to take its Fed funds rate to 6% or higher. Where do I get that number? If you look historically before 2008, typically the target Fed funds level is about 2.5% on average above core PCE. And we think this is sort of where the Fed needs to bring their target Fed funds to really bring this, so the service inflation component under control. Now, what has happened to the bond market as inflation and rates have been raging? I think there's been two effects that we've noticed. One is that obviously we've seen a huge increase in terms of the riskiness of the bond market. Volatility in the bond market has gone up more than about 100% versus, say, 2 years ago. And the other thing that we've seen is the tail risk of the bond market is also starting to show. The rolling 12-month return of the Bloomberg Ag is the worst since the 1980s. On top of that, what we've also seen is a huge increase in the correlation between bonds and other asset classes. Bonds versus equity correlation was negative 0.4 2 years ago. In the last 12 months, it was plus 0.7. And that obviously has some pretty severe implications for diversified portfolios, which are going to look less diversified now. So it's going to be a very interesting environment. I think managers probably need to reconsider their asset allocation considerations, given one, higher bond volatility, and two, this change in the correlation across asset classes.
Great, thank you. So at TradeWeb, we manage a block trading platform for ETFs. We'll trade about $1.5 trillion globally this year. Close to half of that is in fixed income ETFs. And it's interesting because 80% of the individual trades are in equity ETFs, 20% in fixed income, but almost half the volume is in fixed income. So that means we're seeing larger trades. And one of the things that we've really noticed this year are the traditional asset managers, insurance, pension, endowments, really using these fixed income ETFs as a core tool for what they do. So Dave, I thought maybe we'd start with you, and a lot of those are obviously Vanguard funds. It'd be great to elaborate a little bit on how you see clients using the products and what you're hearing this year relative to prior years.
Yeah, I mean, I think we have different use cases for different client bases. If we start with institutional, I think what we've really seen there is greater adoption for what makes the ETF a great vehicle. You have these two layers of liquidity that exist there. It's, if you look at the bond market environment historically over the last, 12, 13 years, it used to be that the major banks were in the storage business. They had bonds available. It was a supermarket of bonds that you could go to. You could transact on pretty much any bonds that you wanted, through those bond dealers. As that dealer inventory has come down post-global financial crisis, we've actually seen an increase in the amount of issuance that has come out. So you create this more fragmented, more challenging liquidity environment in the overall bond market as a result of that. But the ETF becomes a great solution there for those clients that want to get access to those bonds. Because of 85 to 95% of all the volume in ETFs is staying in the secondary market, is just transferring between parties at the ETF level, that is allowing the cost to transact to cross the spread in the ETF is much lower than you would see in the underlying bonds. Probably the most dramatic, product in our lineup for that is our long-term corporate bond ETF, VCLT. It's got about a 15-year duration, and if you look at where the spreads have gone for the underlyings, from around 42 basis points in January to as much as 72 basis points on average in in October, really, it has encouraged the ETF to grow as a vehicle to get that exposure and to be able to cross that spread at only 6 or 7 basis points. So we've seen greater adoption from insurance companies due to regulation in that space, as well as the National Association of Insurance Commissioners, NAIC, has allowed for designations that don't carry that equity treatment like you used to in mutual funds. Now an insurance company can buy something like VCLT to get exposure at the 15-year duration part of the curve, and they can hold it for a period of time while they look for their own selection bias, they look for their own relative value within their portfolio that they want to hold. The ETF is a placeholder that always has a bid available for them. So when they buy VCLT, they can hold it for a period of time, and as they find bonds that they really want to keep, that they really like the relative value, they can sell out of VCLT to fund those purchases. We've seen more and more adoption there from those type of clients. The last thing I would just mention, maybe just as we cross over to the retail space, and maybe I can turn to Brett too, who can talk to some of the institutional as well, is in retail, what we've seen a lot is the model portfolios and just the increase in models as advisors have gone from more of a commission incentive to a more of a wrap fee. Advisors are now no longer really often taking that portfolio management role. They're outsourcing that to model providers to basically get that portfolio management, and we've seen great growth there within ETFs. We'll talk a little bit more later on just how to best execute when moving between those, but with the growth of model portfolios, the ETF is a great vehicle because you can realize with rebalances, as soon as you make that trade to sell out of where you're coming out of, you know exactly what your proceeds are, and you can move that money into where you want to buy into. Historically, with mutual funds, that wasn't available because you'd have NAV at the end of the day. So I think the two biggest cases we see in institutional is just, cash equitization is a big tool, and in retail, it's really the model portfolios has been probably the most frequent use case.
You touched on a couple client segments, and I want to almost expand on what you said. The first that piqued my interest was insurance. And I think a lot of the catalyst behind the growth of insurance adoption of ETFs has really been regulatory. And I don't want to send everyone to sleep because regulation usually sends me to sleep. But, there's been a great deal of almost lobbying on the part by folks like iShares and Vanguard and others to ensure that the regulators, both at the state level as well as through some of the national regulators like the NAIC, are fully educated on bond ETFs and the fact that they are not equities, they are just packaged bonds. And so they should be treated as such from an accounting perspective, from a risk-based accounting perspective. And so that, I think, has been a real catalyst there. And actually, if you go a few years back, I believe it was Texas was the first state where we saw bond ETFs being treated explicitly, right, in their regulatory framework as bonds. That has trickled over, and I think New York, the largest insurance market out there, did the same thing just maybe a year and a half ago now. My timing's probably screwed up.
Finally, yeah, they had to twist some
thank you.
arms over there.
Yeah,
for sure.
exactly, which took a while, right? They're a very conservative regulator. They don't change quickly. So anyways, I think that's been a really interesting part of the market, and that clearly has a ton of room to grow. And we all follow, ADC assets and things to figure out what's happening there. The other one that you mentioned that I think is interesting is, is models. And if you look at what's happened in the model portfolio space, yes, you were totally right. Like that movement from brokerage to fee-based advisory, I mean, it's not just a U.S. phenomenon, though. This is like a global phenomenon. So obviously, we're all seeing it here in the U.S., selling U.S.-listed ETFs, but it's happening in Europe and it's happening in APAC, and there's mandatory transparency where now like an advisor has to show a statement and say, here's all the things that are in your portfolio and here's how much I am charging you at the end of the day. Now cut me a check. Like advisors have to prove their value. So how do advisors do that? Well, they can play Warren Buffett, and some of them fancy themselves that maybe. But like, I think most of them say, okay, my job is to advise clients and to service clients, so I'm going to outsource a lot of that investment management to the home office or to a third-party asset manager. And what is the number one building block in model portfolios? It's ETFs. Now, obviously, we're seeing like the portfolio of the future is going to have, it's probably going to be built largely with models, but we're also starting now to see the inclusion of SMA, of alternatives, of other exposures into those model portfolios, but ETFs remain like the leading exposure. So that's a huge driver of growth. One more thing I'm going to add, and then I'm going to shut up, and that is, thinking about big asset owners like pensions and some of the others. You talked about the liquidity. I mean, ETFs as a portion of the tape grow and grow every year during periods of volatility. What do we see happen? Everyone turns to ETFs as the liquidity vehicle to move. Like you guys know this better than anyone. So it's interesting to see folks like pensions who are moving between separate account exposures, active exposures. What do they use to equitize in between? They used to just hold cash, or they'd pay a transition team somewhere to like do this for them. Now they just plug money into an ETF for a number of days and then they leg out of it. So like you're seeing the ability for investors to like do it themselves, not have to pay someone to do it. I think that's interesting as well.
Yeah, for sure. I mean, I think, just to add on, right, we've seen a lot of tax loss harvesting and the value of using an ETF in that capacity, certainly for a liquidity sleeve as a way to hedge a portfolio. So these use cases are just becoming kind of more common among traditional managers. Anything you wanted to add there, either Kevin or?
The only thing I would say, I think we are the poster child for the model portfolio movement. I joined Henyon and Walsh. You've seen our commercials. We believe the cornerstone of every investment portfolio should be investment-grade municipal bonds. We still do. If you're looking for tax-free income potential and principal protection when held to maturity, bonds pull back to par if you hold them to maturity and stay in the investment-grade space. But we also recognize with the evolution of fixed income products, thanks to everybody up here on this panel, we can now build model portfolios, make them a lot more scalable and efficient for our advisors to use with their clientele. Not everybody necessarily wants a portfolio of individual bonds. And now we can offer diversified portfolios and include fixed income ETFs in them, going up and down the credit spectrums, shortening duration or adding to duration. We can add exposure to areas such as convertible bonds, senior loans, preferred securities, international bonds, all very efficiently within ETF wrappers, and build it into a whole model portfolio construct. So that's really helped us to now grow our business through the RRA to complement the brokerage side of the business that's still using municipal bonds. So everything that they just said, we're embodying, and we're not the only people doing that in this country.
Yeah. To your point on tax loss, though, I want to get back to your question. It's one of the few silver linings in the market is we can all accumulate tax losses right now and they never expire. There's something beautiful about that. So everyone's doing it. And if you look at the flows, what are we seeing happen in this marketplace? I think there's, I'm going to kind of make up numbers because there's rounding, but according to Morningstar, at some point in the past month, there was $900 billion leaving active mutual funds. But in the same exposures, we're seeing money flow into ETFs. What is behind that? Well, everyone's going out and they're harvesting tax losses, and hopefully they'll get to use them over the next decade. So I think that is clearly happening. The ETF is the vehicle of choice for putting those proceeds from tax loss harvesting. And then oftentimes, we'll see folks maybe leverage an ETF and then move out of that ETF into a new mutual fund exposure or some other exposure in the new year. But with the rise of active ETFs, I think we're now seeing folks move into the active ETF and just sit there. They don't need to move back into the mutual fund because at the end of the day, if you're tax loss harvesting, it's in a taxable account, so why not use the more tax-aware wrapper? Like going back into a fund makes no sense. And so that dynamic of using things for tax loss short term is now turning into buy and hold into the new year. And I think that is only going to continue to happen, but hopefully everyone's taking advantage of it this year.
Yeah, I mean, one thing I might just add to, that tax loss harvest trade is, obviously munis is a space where that's naturally going to occur. Tax sensitive clients, as Kevin mentioned, one of the biggest drawdowns in that market in how many years? I can't, yeah, so, and a lot of people's lifetimes in this room probably. But, when you look at that, we've seen a lot of flow out of our active munis, and we've caught a lot into our taxable ETF, our tax exempt ETF, VTEB. And it's usually when you see big drawdowns in a market, you don't usually see those big inflows. But that tax loss harvest trade is so robust this year in that space. And I think we'll see a lot of those assets stay there. And what's really important there is our portfolio managers would rather it be in the ETF vehicle too, because that transient flow that comes in and out of the open-ended fund is going to incur transaction costs for those portfolio managers. So they're going to be more apt to maybe throttle some of the redemptions that come out of those products to make sure that they're not incurring high costs for the existing shareholders. The ETF doesn't have to bear that because we're able to do in-kind creations, we're able to do in-kind redemptions. It protects the existing shareholder, and it really democratizes that cost to the party that's getting in and out of the product. And I think that's why the ETF that's another reason why the ETF is just the vehicle of choice for this tax loss harvest trade.
Yeah, and I just would add, I think, anecdotally, there used to be a stigma around kind of people that were getting paid to manage money using ETFs because there was a fee, and that seems to have gone away because it's become such a useful tool. So I guess we'll transition a little bit here, but with the kind of crazy market and the success of newer ETFs, Scott, I'd love to hear from you on this evolution of the fixed income markets that we've been talking about and what you think that means for fixed income ETFs moving forward that may be a little bit different than the plain vanilla ones we've been talking about.
Sure. Obviously, 2022 was a very interesting year for most asset classes. If you look at the top performers in active ETF space, you would see that only about 5 to 6% of them produced positive returns in the past year. And almost all the top performers are in the inverse asset category. And so is our rising rate hedge ETF. I think if you take it as a potential given that the positive correlation between bonds and other asset classes are going to be sort of the new normal, which it was pre-2000, back when inflation was much higher. If that is going to be indeed the case, then I think portfolio managers are going to start looking for neutral or negatively correlated assets and investments to help really bring diversification back, right? If you look at a 60-40 portfolio last year, the relative change in the volatility of the 60-40 portfolio is more than equities and bonds. So, it seems like new math. 1 + 1 is more than 2, right? But it's really the result of this rise in correlation. So diversified portfolios are likely to look less diversified, and I think people are going to start looking for more alternative types of investments, such as neutral or negatively correlated asset classes, to really bring back that efficient frontier. If you sketch the efficient frontier of a bond moving to 100% equity, it's actually a straight line in the last 12 months. You've lost that diversification effect. So I think as this market continues to evolve, as we think positive correlation comes back, we think negatively correlated asset classes are going to be quite helpful. For example, if someone had put 10% to 20% of our RH ETF into a bond equity or 60-40 portfolio, in the past year, they could have cut the risk by as much as a third. Just 10%, 20%, cut risk by a third. not even talking about returns. So I think that is a type of performance/portfolio attribute that people might be starting to look to in this sort of new world. And the other thing I would say is that if you're looking at active managers, make sure that they bring value added. The way we do rising rate hedge, I think, is different from almost every other manager in the market, most of whom are just outright shorting bonds or buying options to short bonds. We do it in a multi-asset, multi-strat fashion, bringing hedge fund types of technology and perspective into ETF space. We think it gives more flexibility to both monetize potential gains as well as reposition our portfolios. So look at active managers, but make sure that they bring actually something that's unique and that's different as opposed to just shorting bonds.
Does anyone have any questions at all? Okay. So I think, moving on, right, in terms of sort of launching ETFs, right, I'm always kind of curious to see, Vanguard is sort of at one end of the spectrum and Scott would be at the other, and Alliance kind of newer to the game, right? So are you guys what are you thinking about when you're sort of deciding what you're going to launch and how you're going to kind of get the word out? One of the interesting things I think is that a lot of the plain vanilla stuff with ETFs, right? Like you know all the holdings and it's super inexpensive and there's going to be no tracking error, right? Like the sale will change, right, in a sense, and the industry has to catch up with that. But would love to hear your thoughts on that.
I can start because I'll probably be more boring than your answer, Brett, just at Vanguard. But, obviously we, have a really concise lineup. We try to just give kind of those broader diversified building blocks within the portfolio. I think, we haven't, the last product that we launched was actually our first active ETF, our first active fixed income ETF, which was VUSB last April, an ultra short product that had a really great run in its first 60 days. It was the third ETF ever in the fixed income space to bring in $1 billion in 60 trading days. LQD and BOND, when Bill Gross was there, were the only two others. So, really exciting product there for us to kind of go into that active space. Naturally, that's not what is often thought about for Vanguard. We are more passive, so we kind of have where we want to be in most spaces in fixed income, so we tend to be a little bit boring with what we bring to market there. I think we still have some opportunities probably as there's been a penchant towards shorter duration to make sure that we're there for something like munis, have more duration segment there, and that's a lot of stuff that we talk about internally. I think we'll continue to look at the active space, but have to weigh just, how far out in duration do you go before you're starting to give up IP by being daily transparent. But those are some of the things that we think about internally. And, again, we only have 20 fixed income ETFs. That is deliberate. We are really thoughtful to just try to make sure that we're bringing things to market. They're going to have that enduring client demand. So, Brett, I'll turn to you for the more exciting answer to that question.
Yeah, I don't know if mine's more exciting. But no, look, my view on this is sometimes in this industry, we create the supply before we know the demand. We do it all the time, actually. And so where do we see demand, right? Where are clients putting their money? I think it's interesting Vanguard went active at the short end of the curve. Like, I would agree. That's probably a great place to go active, and there's been a lot of product proliferation there. We're also seeing money moving there, so that might be why we're seeing products come to market. I think that's kind of the frame of mind that we try to take, at least at AllianceBernstein, as we're going to market with new ETFs. Now, we look at also what's happening within Bernstein Private Wealth. So we have our own kind of wealth franchise, and we see what they are buying now. Actually, when I worked in iShares, I covered Bernstein. They own a ton of iShares ETFs. So part of my job is to go back and look and say, okay, where's their demand for the ETF wrapper at different wealth platforms, and where should we, AB, be stepping in with an active alternative? And so that's part of the way that we're looking at the market right now. But I think as well, look, we spoke about a few different things, the rise of model portfolios and some of these other dynamics, like what do you need within models? You need building blocks that work. So what are the new building blocks that need to be built that we can stuff into models, because we know that's the fast-growing river, that's where all the money is going, so let's throw ourselves into it. And so we're kind of looking at all those different demand dynamics as we figure out what kind of supply we want to create. Now, I'd be remiss not to mention our tickers. So we have 2 short fixed income products, one taxable, one tax aware, TAFI and year. That's my only ticker plug. But then we're also, we are looking at what we're going to do in the income space through high dividend, low vol, because you do see demand for alternatives to like the style box, right? That's why factors came out. That's why Andrew Yang has a job. Like, you know what I mean? Like people are, they're trying to figure out what are the other forms of investing and what kind of products can be built that work there. There's clearly some demand for that kind of product. So anyways, we're always looking at it, and we're trying to figure out what makes sense to do in an active wrapper, because like I'm sure most people in this room, a lot of your assets sit in index ETFs.
Yeah, Scott?
High dividend, low vol works in any environment.
There we go.
Yeah, as a small asset manager, I think we want to stay with our core competency, which again is to manage portfolios on a multi-asset, multi-strat basis, and we would turn that towards any potential risk mitigation solutions that our clients are looking for. So that's really our starting point and our focus.
Kevin, anything?
As the user of your products, I can give you some demand input to the suppliers here. And I can tell you that if you're looking to come to market with short duration product now, you've probably missed the bulk of that momentum trade, right? Because we were having a conversation at lunch today about actually increasing duration now as you look at the forward-looking yield curve, and now you think even Goldman came out early this week and said that muni bond yields are going to come in 100 basis points by the end of next year. So yields come down, prices go up. So if there was an instrument in the ETF world that allowed portfolio managers or the RIAs who are building their own models, yes, they exist as well, if they had a dynamic duration portfolio that actually adjusted the duration based upon your own investment committee's outlook and did that for them so they didn't have to monitor those strategies and can go out and gather more assets and manage their relationships.
Are you going to
That would
seed
be
it?
a home run.
Would a long duration muni fit for you next
Yeah,
year?
I would
maybe?
certainly be interested in looking at it.
So Brett, historically, fixed income ETF trading, right, has been a little bit fragmented in terms of who's making markets where, who's trading them on the buy side. Maybe if you could talk for a moment about how that's evolved over the last
Yeah, I mean, Adam, you'll know this better than anyone. But it's funny. Before I moved, now I'm at AB. Before that, I was at BlackRock. Before that, I was at UBS. And when I was at UBS, I actually worked in our prime brokerage business for a number of years. And it was funny. I remember, being in prime brokerage, you have to work across equities and fixed income and all these different product lines. But the equity folks sat on 9, and the fixed income folks were like scattered somewhere else. And when you would go and speak to them, they had different teams and reporting structures and like different access to the balance sheet. I mean, they may as well have been different companies, right? Like they had their own cultures. It was wild. And so it's funny. Then you see, like, obviously, financial crisis happens, and balance sheets are constrained, and all of a sudden the market makers step in, and there's you guys and Virtu and Jane and the others come to market, and they didn't have those historical silos. They just didn't. So they could create their company in the modern way, right? Based on how markets work now and how they're going to work into the future. And so it's interesting. They were really the first ones to come in and say, okay, ETFs may be traded on exchange like an equity, but if it's full of bonds, it's a bond product. So it should probably be traded by the bond people. And they were like, kind of led the charge there. And then you saw years later, like Goldman did it. They were probably the first of the big banks to kind of do that. I don't even remember how long ago that was, 5-10 years ago, something like that. But like they started to migrate. You probably know better than I do.
Yeah, it was about January 2017, January 17th.
There we go. There we go. So it just happened. No, but so you start to see that happen. But again, there's kind of been this like shift where folks recognize that it's more efficient to trade bond products even in an exchange wrapper through the bond desk because that's where the knowledge base is.
Yeah, I mean, I see with our users too. I mean, the ETF looks, feels, and settles like a stock, so it had been traded by equity traders, and that has really changed a lot. And sometimes it's not easy to change that based on the order management systems and settlement systems that these buy-side clients have. But they've made those investments over the last few years. It's really transitioned, and then with the transition on the sell side, the sales coverage is now the fixed income sales coverage. So it's just making the entire process more comfortable and bond-like, and I think, that will be a continued catalyst for this kind of thing. So something else I was hoping you guys would touch on, and kind of like a personal story, right? I had not that much money, right, in the savings account, earning like 1 basis point annualized, but I didn't really care because it wasn't that much money. And a couple months ago, I finally, had it. So, I called up Schwab, and actually, they were really good, like in terms of giving me information, but they presented kind of munis and then treasuries and the different tax structures. And again, if this was an exorbitant amount of money, these decisions would have, mattered more. But, I was wondering if you kind of hear those things from clients, and I just thought it would be useful for the room if you could talk a little bit, assuming you guys know, right, about kind of treasuries, munis, money market funds, right? Kind of what are the hot topics in terms of who's choosing what and why?
Yeah, it's interesting, Adam. So, when I was talking about how we have the Bernstein private wealth platform at AB, when I speak to some of the advisors there, they're getting a lot of demand actually from their own clients for treasury products. Be like, I want to be risk off. I see all this volatility. This is my retirement, my livelihood, whatever it is, right? Like, put it in something safe, and now I can get 4% in a 1-year T-bill. So like ladder that. And it's interesting. I mean, sure, there is that as an option, but you then have to consider things like the tax consequences on the income that T-bill is kicking off. And when you like kind of run the math, 4.5% quickly becomes like 3%. And so if, an ultra short muni product, maybe TAFI, TAFI, is going to give you a 3.5, maybe you should be using that.
Second plug.
Yeah, sorry, I'll stop. So, but I'm just saying that these are conversations that happen. So should you be using a T-bill and laddering and monitoring your maturities and like going through the headache of doing that? Or should you be using a different product? And I think advisors need to be educated on how to do the math and how to think through those decisions when they're recommending products for their clients.
Like Scott, Kevin is kind of the investment guys. Is this something that kind of comes up a lot?
What we're hearing a lot right now from the advisors we work with, brokered CDs, right? You can put client money into a brokered CD. It's going to mature in February of 2023, and they're making 4%. Safe money, you're getting a high yield. But what are they doing to make that trade? They're taking money out of the market, right? We've all seen the studies. Trying to time the market is often an exercise in futility because you got to be right twice, when to get out and when to get back in. Over the last 25 years, had you just missed out on the 10 best days in the markets, your returns would have been cut in half. So if now you're telling your advisor that I am risk off, I just want to earn income, well, then maybe that brokered CD or short-term T-bills is what you need. But if you're trying to time the market and get out of the way of this type of market volatility and think you're going to get back in after it because your risk tolerance has now changed and now you're risk on again, you're going to miss it. And then often it's those very investors who fall short of their longer-term financial goals and objectives. So that's why I think the model portfolio route makes the most sense for most investors if they're honest with you about their true risk tolerance and what their real growth and income objectives are.
Yeah, I think what I hear from some of our investors is that I try to capture income by buying ETFs like float and trying to buy other types of products that would generate higher income, such as tips, for example. And they've been disappointed because they get some higher income as rates rise, but their total return is negative because if you buy float, you're buying corporate papers, corporate spreads widen, and therefore your total return is negative. So that's something that, the income versus total return is something that a lot of investors didn't really come to grips with as they're thinking about this question.
So are there any ETFs that are sort of stripped that out on the fixed income side that you would sort of recommend, or assuming they're Vanguard funds?
Yeah, I mean, I'm not going to say any names, but there's certainly some duration hedged ETFs that's out there that basically takes out the duration out of spread products. Now, you're still going to be subject to spreads widening out, but at least you've taken some of that duration pain out of the overall equation. Right?
And David, these conversations that you're having a lot with institutions or more on the retail side, both?
Yeah, I mean, I would say, just because our lineup doesn't really have that much optionality there for kind of hitting some of those elements, the story tends to be a little bit more, focused around just what fits into your model, kind of that transition. The one thing that Scott mentioned, I mean, tips were really hot last year as everybody felt inflation was coming. This year, it's the opposite. I mean, I think 5 of the 10 worst performing from flows in the entire fixed income lineup are tips products from large issuers like ourselves, iShares, Schwab, and others, because I think people had false expectations on what it meant to be into that. If inflation's going up and I buy tips, then I'm going to get a higher return from that. They're not realizing the other impacts that exist there. And I think, that's part of what we try to make sure that we're telling that overall story. And, naturally we're a firm that really, tries to reinforce the stay the course mentality. Don't try to market time, buy and hold, stick to what your long-term strategy is. It's very tough, as Kevin mentioned, to get in and out of securities, and try to play certain tactics or themes in a short term, even for large institutions. I mean, I often talk about, when you watch CNBC, of course, when you watch Kevin, it'll be really good insight, but often you get, you get 4 people up there, 2 people say one thing and 2 people say the other. And they're all professionals, they're paid well for it. It's just nobody really knows what's coming next. If we did, then we'd all, we'd be in a different spot than we are, right now. So it's really just being able to react to those environments and try to stay the course, make tactical adjustments where you need to, maybe come down in duration if you feel like, there's going to be an impact there. Maybe you have to go up in quality in a certain part of the credit cycle. That is, that's understandable, but you have to be careful of not to try to chase returns. And I think that's what we saw. Like, I think tips just recently is a really great example of that, of people putting money in, getting an experience they don't expect, and taking that money out. They probably had a terrible experience from an investment outcome standpoint.
Very well said.
Any questions from anyone? Yeah. Thank you for doing that. Yeah.
You guys talk a lot about model portfolios and how they're facilitating the increase in fixed income ETFs. Are you guys concerned about the SEC's proposal for investment advisors to have increased oversight over model portfolios and the increased costs that would bring around those investments?
I'll start with that. Advisors should be. And what we've done at Henyon & Walsh is we've centralized the whole investment function. We have an investment committee. The advisors can't select their own model portfolios. They can't actually build their own model portfolios. They have to work with a member of our investment team. They can only sell the portfolios that we've created and compliance has overseen. So I think we've already accounted for exactly what the SEC is aiming for. But for those advisors who are trying to build and run their own portfolios, they should be concerned and they should be looking to do something similar or perhaps even outsource. That's my thoughts.
Dave, any thoughts on that? Or
Yeah, I mean, I think, I absolutely agree with Kevin. I mean, I think we tend to see, and I think there's growth in that, in the spirit of like a CIO type of model often where you kind of roll it up to, there's investment professionals that are thinking about this that are very qualified. There's teams of people that are coming together and using economic research and taking that next level. I think that's where investors should be, focused, is on those type of, companies that are doing that due diligence for them. The advisor as PM is just, I think it's a time that's passed now. It's not, it's very difficult to do. There's, a lot of beta in the market, and it's tough to, outperform and really, deliver that alpha in your own kind of, personal, thoughts on the market. And I think having a team oversee that just makes sense in general because it allows for different voices.
I think this is also why we're continuing to see model proliferation, because the third-party managers as well as the home offices are coming out and trying to fill in that gap. For not only do you have that movement from brokerage to fee-based, but in addition, you have folks saying, okay, I need to outsource risk. They're looking for like litigation management, right? And they're doing it through a model. And so, yeah, that creates opportunity for folks like all of us here to come up with models or sell into models. And so I think we're going to continue to see proliferation of those, including things that are a bit more custom. We're starting to see some of the RIAs start to do more custom models themselves, or they put their touch on things. Some of the big managers are coming out and running those on behalf of advisor practices and RIAs. So yeah, I think you're just going to see more centralization of the decision making for sure.
So kind of sort of circling back to that question, the really large models that have a big following are probably already doing a process that would meet, what the SEC might be talking about, whereas individual advisors. Got it. Scott, any thoughts kind of around
No,
that?
I have nothing to add to that.
Yeah. Okay. So I guess, kind of looking into the new year, kind of any trends that you guys think will, either continue or sort of develop, or, any kind of predictions, I guess. Scott?
Sure, I'll take a stab at it.
Keep it positive, Scott.
Talking to the wrong bond guy. What we're seeing, I think, in this past year is that central banks have been selling bonds. If you look, or not buying, they're buying new bonds. This past year, we've seen about 500 billion of treasuries being sold, 300 by Fed, 100 by China, more than 100 by Bank of Japan. And if you look at next year, it's going to more than double. You're going to have almost $1 trillion of net duration sales by the Fed. You're going to have ECB selling about 200 billion. You probably have Bank of England selling a few tens of billions, not counting how much Japan or China could continue to divest. So again, as central banks sell, you're moving treasuries from rate-insensitive hands into rate-sensitive hands into the hands of folks in this room. You're not just going to go buy bonds willy-nilly. You're going to do your analysis. You're going to have return hurdles. So it's going to be a continued sea change over the last, versus the last 40 years. Now, central banks are selling, and the cost of yield has got to go up. So, things that I would watch out for this next year is something that Chair Powell said. He said the wage price spiral is a very bad thing, to paraphrase him. Now, given our Act 1 and Act 2, we've already seen the first two steps of the wage price spiral. We started having prices go up, now wages are going up. And the question is, in 2023, are we going to see prices, which are starting to stabilize, is that going to go up again? Because then you're starting down the spiral, and that's something that I would really be on the lookout for.
Got it. And how do you prepare kind of ahead of it? Like, is there a way to position kind of?
Well, by RH. I think it's really something to think about how your asset classes will really perform in a high inflation, high interest rate environment. And you can certainly think about asset classes that are kind of front and center in a rising rate environment in terms of negative performance. Probably about 3 years ago, you can certainly conceive of things like tech, right? Discounting of future tech earnings is going to be pretty hammered if rates keep rising. Things like emerging market, right? The carry trade is going away. So there are many asset classes that just outside of straight bonds that are going to continue to be negatively impacted if inflation remains high and if interest rates remain high and central banks keep selling.
Yeah, please jump in.
I'm happy to talk a little bit less on the investment side, but more on the business side. Like, what are we thinking about for next year? And I'm not going to project on anyone else, but this is just like our personal kind of view. So we launched obviously our first two products in the U.S. We're going to continue to launch U.S. listed ETFs, but that's not enough. And so one of the things that we're thinking about at AB is what are we going to do through our UCITS program? Like, what kind of program do we create there? And understanding the different market dynamics within Europe and Asia. And where we want to go. And so you look at kind of like mandatory savings in Australia, right? Like massive pension scheme. Is there something there? I don't know. We don't know. But we talk about these things. So we're always trying to figure that out. The other thing, too, I would just add, and we all see this, there's a movement to private markets still. We talked about insurance earlier. They're like huge buyers of private investments. That growth continues. Same with pensions. Some of these big asset owners. Now everyone's moving into retail, trying to do it in retail, building out their sales teams. We've all seen the hiring on the street for this. And that is like something that's going to continue. So I think that's an interesting space to watch. What role does private equity, private credit, et cetera, play within a retail portfolio? How is that going to change and evolve? I don't have answers to any of these things. I just think they're interesting. So we're looking at that as well. I'm sure I forgot a few things, but.
Yeah, Kevin.
So I know I'm not going out on a limb here, and if you want to quote me on this, you can, but my forecast is that the growth and adoption of ETPs is only going to continue, if not further accelerate, because the evolution of all these types of exchange-traded products that all these gentlemen have come up with is starting to coincide with this mass movement to fee-based money management. And that's not just taking place in RIAs, it's also taking place at the wirehouses. When it takes place at those wirehouses, they build models. Those models look to incorporate more products to make them proprietary, and that's only going to fuel the rise in exchange-traded products even further. So if you're not on the ETP bandwagon already, you should get on it soon. But do your due diligence, because not every exchange-traded fund is created alike.
Dave?
I guess I would just add, I mean, I think for us, we've naturally been a retail-based, retail-focused organization for a while. I think we understand the importance of liquidity and making sure our products have a really strong, robust volume in the market to handle, large trades that have resiliency in the market. So I think we'll have a continued focus on the institution, on the insurance channel. One of the big things there that we, Brett warned he was going to put you to sleep with regulation. I'll touch on it quickly too, but just there's the idea of still in a few of the, the majority of the commissioners that kind of look at the ETF still as a CUSIP level security, not looking through. So there is bounds on how much you can hold. We think if that wall comes down, then there's really going to be, a heavy tailwind for usage of ETFs and other portfolios that will allow them to go above these CUSIP limitations, because it's looking through to a product like our intermediate corporate VCIT. How many tickers did I support? It's been more than 2. But something like VCIT has almost 2,000 tickers in it. So really, when you think about the diversification you get with just a $100 million purchase into that as a large institution, it really breaks down into those 2,000 names. It's not just at that top level. As those things come down, that'll be another catalyst for ETPs to just continue to grow and get larger scale. And that's good for all investors, really, within our products, because that additional liquidity means our spreads get tighter. As our spreads get tighter, even your 100 share round lot or 2 share odd lot is going to be a cheaper transaction for you if those costs come in, and that's something that we're really focused on.
Yeah, I would say in 2023, my perspective is, be defensive. If you want to over-allocate to equities because you think they're cheap, have something on the other side as sort of a barbell strategy, so that if you're wrong, you cut off some of the negative tail, right? Because one thing that is for certain is that as we start to approach the end of the Fed tightening cycle, you're going to see a huge increase in volatility as the market starts to figure out, tries to bet on when that subsequent cut is going to take place. So I think 2023, we're still going to see some pretty elevated volatility, and risk management is going to be key.
Great. All right. Any questions? Yes.
A question for Dave. How is all the advancement in technology of trading bots, whether it's portfolio trading, algo trading, trade webs and market accesses, how has that affected your ability for a client experience for like really big trades, do big creates or big redeems? Has it changed a lot in the last 5 years?
Yeah, that's a great question. I really think that when you look at portfolio trading in bonds, it's a newer concept. Just over the last really 5 years that we've seen the growth there. I think ETFs are really the catalyst for that. The idea that when you're creating a basket of securities for a creation, if you think about the most dramatic example is our total bond market index. You have 12,000 securities, but we're usually only creating with about 200 bonds. We want to make sure that those 200 bonds have the right diversification of maturity, credit quality, of sector within them, that it's going to be a good risk-neutral basket, that when we take that 200 bonds in, it's going to track like the overall fund. That's the same concept that exists in portfolio trading. So there's an interlinked growth between both of those that is really positive for investors, because now if I'm a market maker and I redeem, say, one of our Vanguard funds and I get a list of bonds, before portfolio trading, that could be an operationally complex, process to get out of each of those bonds, to be able to trade out and find buyers out there for those bonds to clear your risk in the individual securities. Now I can take that whole portfolio, and maybe my client doesn't want all 100% of those bonds from the redemption basket. They only want 80%. But now I'm there where I can do one trade to clear my risk of 80% of that inventory I received. Now my cost just changed dramatically. So I think there's a real interlinking there. I think the rise of certain bond platforms that are really thoughtful around portfolio trading and incorporating ETF baskets right in there that allow dealers to interact between a portfolio as well as an ETF basket, find linkages on what fits well together, I think is only a good thing for investors to try to make bonds a bit more easy to trade, really, is the simplest way to put it. And with that and more trading in bonds, hopefully you get more price discovery in bonds, which helps to bring clarity into pricing of the pooled vehicle, the ETF, so we avoid certain dislocations that occur in the market. So I really think that advancement, I think the ETF is a big genesis of that advancement, both from portfolio trading and just from the use of platforms. And I think as that continues to have interconnectedness between them, it's only a positive thing for investors into the future.
Yeah, I agree. I mean, I joke around internally because they talk about the portfolio trading like they invented the iPhone when this has been around in equities for 30 or 40 years. But now that it's happening and these liquidity providers are making markets in individual bonds, the bond ETF, portfolio trades, they may be super axed to buy something at 10 a.m. and axed to sell it at 2 p.m. So the idea of coming in via TradeWeb and getting an aggregate best bid and best offer, the end user essentially can take advantage of how the liquidity provider's book is positioned at any given time. The size of the trades is just is unbelievable, really, that comes through. I mean, we've had many over $1 billion, and they take, literally somewhere between like 10 and 15 seconds to do, depending on the ticker. And when I go and talk about it to the bond people internally, they're shocked by it. But it's really an incredible tool.
Yeah, I think really that speed is an important element. I mean, how many of your, the liquidity providers on your platform, Adam, are auto quoting up to hundreds of millions of dollars that you can get a quote back in seconds for them to be able to price that in that time period relative to where we were 10 years ago? It's an incredible advancement, in that asset class.
For sure. Other questions? Yes.
This one's for Brad on distribution. How have you and your team of specialists partnered with the existing wholesalers at AB who've been comfortable selling mutual funds for the last 20 years, and what's kind of that dynamic?
Yeah, it's a very good question. And let me just be very honest with you. We're still figuring it out. But, I think part of it is, one, it's education. I mean, many of these folks they've been exclusively selling mutual funds and SMAs for many years. In fact, they were often selling against the ETF wrapper. So we're kind of coming in and saying, whoa, let's re-educate, bring in some of this ETF DNA into the team and get folks fired up. So that's one, there's training. Two, aligning incentives. As with anything in this world, when incentives align, people do their jobs. And so that's something that we're still, we have a temporary answer. I'd love for it to be a long-term answer. I think that's another component of this. And then I think three, it's really like we having a specialist sales force, we do nothing but think about ETFs and hopefully soon models all day long. And so part of my job, I was actually talking to someone in the audience, Stephanie Schultz, today about this. Like, part of my job is to sometimes call on wholesalers and say, how's it going? Who have you spoken to recently? What about this big RAA I know you cover out in California? Like what's going on? When are we speaking to them? Like, that's part of my job. And so there's a mix of like aligning incentives, influencing people, and educating people, and sometimes shaming people.
All right. That was weird at the end.
That's last.
Anyhow, anything else? All right, well, I think this was a great panel. We touched on a lot of interesting topics, so thank you guys very much. And I think everyone will be around kind of for the rest of the day. So